So thanks for very much for giving this talk, Shohini. I'm delighted that you are with us today, and for the courageous woman joining on an Easter Monday as well. So Shohini is doing some fascinating work on granularity and networks in banks. So delighted to hear what you have to say. And Shohini is okay with taking questions during the talk as well.
Great. So thank you for the introduction. Thank you, CEPR, for giving me the opportunity to present this today, and Hélène for hosting. This is joint work with Nishant Vats, who is a PhD candidate at the University of Chicago. So the main question we're after in this paper is, how do non-capital shocks transmit through banking linkages? Addressing this question is important to study how different types of shocks have varying macroeconomic consequences. So in theory, when banks are the primary source of aggregate fluctuations, banking integration can result in the synchronization of business cycles. But when non-banking shocks are the primary source of aggregate fluctuations, theory suggests that business cycles are decoupled and they can experience negative co-movement of business cycles. And while there's been a plethora of work that's examined the transmission of bank capital shocks through banking linkages, the study of non-bank capital shocks has been pretty bare. So in this paper, we present a mechanism of how banks can act as aggregators of non-bank capital shocks, which we'll refer to as idiosyncratic shocks, throughout the presentation. So what is the key difference between idiosyncratic shocks and bank capital shocks? Bank capital shocks directly affect the aggregate amount of loanable funds, while idiosyncratic shocks affect the relative lending share across geographies while keeping the total stock fixed. And hopefully this will become clear in just a few slides. So the reason why we look at this question is that it's a key issue in both the international shock transmission cross-borders spillover literature and also the finance literature. So standard IRBC theory, going back to Backus, Keogh, and Kydland, predicts that idiosyncratic shocks under financial integration leads to lower co-movement of output, while aggregate and correlated shocks lead to higher co-movement. And in standard banking models like Holmstrom and Tirole, the predictions are the same, that under real shocks, financial integration leads to lower co-movement of output, but the opposite is true under financial shocks or shocks to bank capital. So this project is also motivated by a recent policy imperative. And in recent years, the European Union has proposed and implemented steps towards the creation of a European banking union and European capital markets union. And this is part and parcel of a broader economic and monetary union. And the goal of these unions is to converge the economies of EU states and improve the resiliency through a centralized shock absorption system. But the question we ask in this paper is, does a stronger financial union necessarily lead to greater convergence? So the idea is the following. Suppose there are only two states in an economy. There's Virginia and there's Maryland. And Virginia's chief exports are soybeans, and Maryland's chief exports are airplanes. So prior to deregulation, the only way these states are connected is through an export-import channel. And you can see that these blue dots are banks in Virginia and the yellow dots signify banks in Maryland. And so the only way these states are connected is through trade. Now with deregulation, in addition to a trade channel, there's also a banking channel. So Virginian banks can branch out to Maryland and Maryland banks can branch out to Virginia. So now you have blue dots in Maryland and you have yellow dots in Virginia. And what this means is that in any given year, if Virginia experiences a bad shock, say a drought or some natural disaster, and they can't harvest as many soybeans, banks will divert their capital out of Virginia and invest into Maryland. And the increased investment in Maryland leads to greater economic growth in the state. So what happens is that after banking integration, the choice set expands. So banks can allocate capital between states rather than being limited to one. And that's what connects shocks in one state to economic growth in another. So if there are shocks to state I, banks will divert their loan supply to state J, and an increase in the loan supply in state J will foster greater economic growth in that state. So next, I'll discuss a simple statistical framework that is going to underlie our empirical specification. And this is a framework in which the transmission of non-bank capital shocks to domestic economic growth depends on banking linkages. So there are cap I states and there are cap K banks. And lowercase I and J denote states, and lowercase k denotes a specific bank. So banks can operate across several states, which are the only linkages in the model. And there are several types of shocks in this model. A denotes aggregate shocks, eta denotes shocks to bank capital, and nu denotes expectations of future shocks. So we can represent a bank's lending growth as being the sum of an aggregate shock, a bank-specific capital shock, and local and foreign demand shocks. And foreign shocks are interpreted as shocks that can affect loan demand or future returns on capital, but they're uncorrelated with the bank capital shocks and other fundamental shocks. So there are two key assumptions in this statistical framework. The first is that banks have a fixed amount of loanable funds and states have to compete for them. So you can see that the local shocks have a positive sign and the foreign shocks have a negative sign. And a second key assumption is that the impact of the shocks is proportional to the lending depth of the bank. So we posit that lending affects economic growth given by this relationship. And so then by substitution, we have a relation between economic growth and lending, which shows that the effect of bank capital shocks increases as the reliance on that bank for external funding increases. And the foreign shocks negatively affect domestic economic growth, depending on the banking integration between the foreign and domestic economy. So the key idea is that these foreign idiosyncratic shocks negatively affect domestic economic growth through banking linkages. So now for the institutional details of what we do in this paper.
Sorry, just a clarification. So what if you invest in a neighboring state, but then that leads to more imports from the original state? I mean, then investing in a neighboring state would have a positive effect on the domestic growth. So I mean, there's only linkages for the banks here.
So in this statistical framework, there are only linkages through the banks. In a couple slides, I'll show that there was a change in the transmission of shocks with deregulation. And if you had greater investment in one state and states were connected through trade, initially that led to positive co-movement, but later this changed over time. So I'll show some empirical evidence in just a couple slides.
Okay, but that's an assumption at this stage. That's
Yes, at this point, we're just making an assumption that the only linkages are banking linkages, just to illustrate the key mechanism that these foreign idiosyncratic shocks can negatively affect growth through the linkages. Okay, so as a natural experiment, we exploit variation from the period of interstate banking integration. And so state pairwise banking deregulation dissolved regulatory barriers, which enabled the cross-border banking expansion from the 1980s through the 1990s. And the reason why we use this period of deregulation is that it provides a clean identification of quasi-random changes in banking linkages across states. So in 1927, the McFadden Act passed in the United States, which prohibited interstate branching, and it only allowed national banks to branch within the states in which they were based. These prohibitions lasted until 1980. And states began getting rid of these prohibitions from the early 1980s, and they began deregulating on a bilateral basis. So a bank like Massachusetts and a state like Massachusetts and a state like Maine could have entered an agreement allowing Massachusetts banks to operate in Maine and Maine banks to operate in Massachusetts. So this agreement occurred bilaterally. And this started in the 1980s and then lasted until 1994, when the Regal-Neal Interstate Banking and Branching Efficiency Act passed, which allowed banks to branch across state lines. And we argue that state pairwise deregulation provides an exogenous source of variation for a number of reasons. So first is the key assumption that states didn't cherry pick the states with which they deregulated based on pre-existing trends in economic growth. And we also control for geographic patterns of deregulation through fixed effects. The other key assumption is based on findings in the past literature, which has found that most lobbying activity for deregulation was pushed by small banks and insurance firms, neither of which are responsible for the expansion of credit that happened after deregulation. So this setting is plausibly exogenous. The way we construct idiosyncratic shocks uses the methodology of Gebek's 2011. So Gebek's 2011 argues that idiosyncratic shocks can explain a large part of aggregate fluctuations because of fat tails and finite samples. So first, what we do is we measure labor productivity as the log ratio of sales to employees at the firm level. Then we construct the idiosyncratic shock at the firm level by taking out an industry cross-year fixed effect. And then we aggregate the labor productivity shock for each firm I in state S to the state level by using Domar weights of the sales to GDP ratio. And we do this for the top K firms in each state. So why do we construct the shocks in this way? We focus on these idiosyncratic productivity shocks for several reasons. The overarching objective of the paper is to document that these idiosyncratic shocks can transmit negatively across borders. So the first reason why we use these shocks is that the shocks are constructed for large firms, and large firms don't primarily rely on bank credit for external funding. We verify this assumption by looking at the ratio of bank debt to total debt for the firms that are used to construct the shock, and we compare it to all other firms in the CompuStat sample. So we find that the median bank debt to total debt ratio for the firms used to construct our shocks is 24% compared to 45% for all other firms. And so this suggests that the state level idiosyncratic shocks constructed from labor productivity shocks to large firms appear to be prime candidates for constructing idiosyncratic shocks. The second reason why we use these shocks is that the shocks are geographically isolated and they don't exhibit long-run temporal dependence. So we examine the temporal persistence among these shocks by plotting the kernel density of the AR1 coefficients for gamma. And you can see that there's very low persistence among the shocks and the average value is around negative 0.093. We also look at the spatial correlation between the state level idiosyncratic shocks. So what we do is we do pairwise regressions between the idiosyncratic shocks across states. And then we plot the kernel density and we find that the mass is concentrated around 0. So the state level shocks do indeed appear to be local in nature and not very persistent. These idiosyncratic shocks, however, they can predict economic growth. So this figure presents a bin scatter plot of the idiosyncratic shocks on the x-axis on subsequent economic growth on the y-axis. And this line is upward sloping with a beta of 0.67. It's significant at the 1% level, and there's a model R-square of 7%. And then lastly, there's a major concern that maybe we're actually not capturing idiosyncratic shocks, but we're capturing shocks that can also affect bank capital. So we conduct a narrative analysis, and we find that these shocks are related to firm-specific events. For example, Whirlpool experienced a large positive shock in 1977 after they introduced the first automatic clothes washer and microwave ovens. Intel experienced a positive shock in 1990 when they launched a new microprocessor. And you can see that based on the description, the majority of these firm-specific events are related to restructuring activity within a firm, some hostile takeover attempts, leverage buyouts, litigation, scandals, mergers, and other corporate governance issues. So based on this analysis, it appears that the shocks are idiosyncratic in these dimensions.
So may I interrupt before you continue with the results? I just have a question regarding the big picture motivation. So if I understand correctly, you want to take these idiosyncratic shocks and say, before the deregulation, there was essentially, if you have a negative shock in one state, lending and as a result, output didn't decrease as much as after the deregulation because banks, let's say, transferred funds from the state with the bad shock to the state that's growing, something like that, right? Is that the
So the key idea is that before deregulation happened, the only way states were connected was through trade. So if Indiana experienced a bad shock, Illinois also experienced negative economic growth.
Yeah.
But then afterwards, banks can intermediate between states, and so they can smoothen shocks essentially that are experienced in one state by reallocating capital to another.
But I guess the reason why I'm asking for the big picture motivation, because the big benefit of the deregulation, of course, is you're allocating capital efficiently. So in steady state, everyone will be richer. So, you know, these states will be all significantly richer relative to prior to the deregulation, if indeed banks are doing their jobs of allocating capital efficiently. So even if we have, let's say, more volatility around it because of some of the transmission channels that you're kind of telling us, are we trying to get any welfare implications out of this? Because the fact that, you know, you get more volatility around a higher, you know, steady state, we still are probably better off with the regulation relative to or without. Like, I'm just trying to understand what's the big picture motivation. If I was teaching this paper, how should I motivate?
So this paper doesn't speak about the welfare implications because there are kind of two dimensions which can affect aggregate fluctuations. The first is that we know this paper is going to document that idiosyncratic shocks negatively transmit across borders, but bank capital shocks can positively transmit. So it's unclear in aggregate which of these forces is going to dominate. But we did do an exercise at the end of the paper in which we calibrate it to a model and show that depending on the degree of financial integration and depending on how correlated the shocks are, you can either have greater volatility in economic growth or less volatility. But the paper doesn't take an exact stance on whether welfare will be higher or lower. Okay. So this figure is basically the main point of the paper, which documents the relation between economic growth in state I and an idiosyncratic shock in state J over time. And we plot the estimated betas from 5-year forward rolling regressions from 1978 through 1995. So as you can see, beta monotonically declines from 1978 through 1991, decreasing from +1 in 1978 to -1 in 1991. And so what this suggests is that states behaved as complements before the mid-80s and more like substitutes after the mid-80s. So in other words, good news for Illinois meant good news for Indiana in the late 1970s and early 1980s. And this changed in the mid-1980s when good news for Illinois translated as bad news for Indiana. So for illustration, we run this regression during the pre and post periods, if you're concerned that perhaps the trend in the bin scatter might be driven by outliers, and we compare the beta coefficients. And you can see that there are stark differences in the pre and post periods, which codifies the notion of state complementarity and substitution of shocks and growths. So the goal of this paper is to attribute this changing relation over time to banking integration, and that's what I'll show next. Excuse me. So in our baseline specification, we run a state pairwise regression of GDP growth in state I on the idiosyncratic shock in state J, a post dummy, which indicates whether the two states have integrated, and the interaction of these two variables along with the number of state and time fixed effects. So in column 1, we have no fixed effects. In column 2, we include year fixed effects. In columns 3 through 6, we include a combination of region cross-year fixed effects and state pair and state cross-year fixed effects. So this is intended to control for geographic patterns of deregulation if you believe that two states are connected for non-financial reasons, or if to control for state level trajectories in economic growth. So as you can see from the sign on the interaction term, the cross-border transmission of shocks changes post-banking integration. And what this means is that a negative shock in state J increases economic growth in state I. And specifically, we find that a 1 standard deviation negative change in the sign of the shock increases economic growth by 0.05 percentage points. So using this setup, we then use the granular instrumental variable methodology of Gebex and Coyen to analyze the relation between lending supply and change in growth. So the objective of this regression is to study the relation between bank lending in a given state and economic growth in that state. So in the first stage, we instrument for the amount of lending in a state using shocks to other states, as well as the timing of banking integration. So essentially, the first stage is the same as our baseline specification, but we use lending instead on the left-hand side. And then in the second stage, we then regress state level GDP growth on the estimated value of lending from the first stage. So for causal identification, we need to satisfy two main conditions of relevance and exclusion. The relevance condition states that the relation between idiosyncratic productivity shocks in foreign states and bank lending in home states is related. And the exclusion restriction says that the idiosyncratic productivity shocks impact bank lending through a loan supply channel and not a loan demand channel. And that's a pretty strong condition, but even if this condition is violated, our identification strategy is still valid if either one, loan demand fluctuates, but the covariance in loan demand between two states is fixed around deregulation, or two, if the loan demand fluctuates, but the covariance in loan demand is sticky relative to the loan supply around the deregulation shock. And we consider several challenges to the strong identification assumption and counterfactual scenarios of violation, which I won't go into in the interest of time. But the main point of doing the exploration of what happens if these assumptions is violated is that even if these assumptions are not valid, the estimates are likely to be downward biased rather than upward biased. So we present our GIV results in this table, and the first stage results are presented in odd number columns, and the second stage is presented in even number columns under different specifications. So in the first stage, we instrument for the amount of lending in a state using shocks to other states, as well as the timing of banking integration. And then in the second stage, we then regress state level GDP growth on the estimated value of lending from the first stage. So overall, we find that a 1% increase in bank lending through the loan supply channel increases economic growth by 0.05 to 0.26 percentage points. So how does this compare to past estimates in the literature? Most recently, Hélène 2020 estimates that a 1% decline in the aggregate bank lending supply reduces aggregate output by 0.2%. And that's comparable to the range of estimates we find. Our lower bound is more conservative than the existing literature, and that may be because prior work usually only uses negative shocks to identify changes in the loan supply, whereas we use both positive and negative shocks, which are likely to affect the loan supply elasticity asymmetrically. Our sample period is also not restricted to the aftermath of financial crises or recessions, which can also be associated with a higher magnitude. And we discuss more issues related to magnitude in the paper.
Could you explain again a little bit the geography of the whole thing? So the deregulation happened between states which were neighboring states, not neighboring states, very much linked by trade flows, not very much linked by trade flows. Is there any kind of statistics on this?
So the past literature doesn't find that states were likely to deregulate with their neighbors or that there's any kind of geographic connection. It is concerning if states that are connected through trade are more likely to deregulate earlier and experience negative transmission of these shocks. So to control for this, we try to include high dimensional fixed effects to control for geographic patterns of deregulation. That includes having region cross-year fixed effects if there are aggregate changes that occur in a region over time, as well as state pair fixed effects if states are connected through trade and trade is unlikely to be affected over time, and then state cross-year fixed effects. So the existing literature doesn't document that the geographic patterns are that states were more likely to deregulate with their neighboring states, but to control for any other factors or that can contribute to geographic correlation and deregulation, we include these fixed effects.
I mean, the kind of puzzling thing for me is that so the mechanism relies on, if I understand well, for capital flowing. If you have a good shock in your, New Jersey because these new contact lenses thing, for example, so suddenly you attract more capital, and the capital comes out of another state somehow. Yeah. That's the okay. But in order to do this lending, so usually banks, they lend where they have expertise, right? They have some. It's not that you can start lending to an industry if you don't know anything about that industry. Usually. That's right. Yeah. So this is why right now we are all very worried, or about the tech firms, because there were some specialized banks lending to the tech firms, and it turns out that they are going down. And so who is going to lend to a tech firm? JP Morgan is not really able to have all the expertise and the knowledge, etc. So is there anything like that going on in the data? So are there kind of specific knowledge, and so how do we go over that to have this capital flying to these new type of industries who are popping up because of a good shock, discovery shocks or things like that? I mean, isn't there some kind of links between the banks who are lending to these new positive shocked places? Is it something you looked at, or?
So that's a great question, and that's something that I think poses a threat to the key mechanism. A limitation of our data is that we're not able to observe the exact pairs between banks and firms which they had their portfolio, which makes it difficult to understand whether there are banks that specialize in particular industries and whether they are able to take advantage of diversification benefits if they're highly specialized in one particular industry. So I think that's something we have to
maybe a suggestion: if you have data on interbank lending, maybe the regulation implied that now bank in state I can lend to the banks in state J, and that is the channel through which you got. I mean, I don't know whether the deregulation. Maybe I guess I assumed it was prohibited for them to lend to each other, right? In order for deregulation to work, otherwise it's not effective.
So I will provide some evidence in 2 slides, which will show that banks did indeed expand across state lines, and that we do see that the total amount of capital that flows into other states does indeed increase after deregulation. So it does suggest that banks, most banks, or rather banks in aggregate, do appear to increase investment after deregulation. Okay, so let me show that in just 2 slides. I'll cover these a little bit faster. So we try to understand the underlying mechanism by studying how bank constraints can affect the real economy. And unconstrained banks, which operate at the first best investment level across regions, they can exhaust all investment opportunities. But in contrast, constrained banks can't exhaust all investment opportunities because they have limited funding. So these constrained banks will divert funding to other regions if they're hit by an idiosyncratic shock in a particular region. And so, consistent with this idea, we show that the transmission of idiosyncratic shocks across geographies is more pronounced when banks face tighter capital constraints. If banks have looser capital constraints, they can diversify their portfolio and they can exhaust all investment opportunities because they have sufficient funding. And so this documents that constrained banks amplify transmission. So a key concern is how exactly do non-bank capital shocks transmit to the economy through banking linkages? Now, a key argument that we make is that the geographic expansion of banks provides diversification benefits as long as the shocks are not correlated across geographies. If the shocks are correlated, then there aren't diversification benefits. So our hypothesis is that shocks which have low R-square are larger in magnitude and have a larger effect. Our second hypothesis is that now, after banking integration happens, banks experience lower market power and they face more competition. So essentially, prior to banking deregulation, banks could have foregone rents in one period with the expectation of recouping losses and profiting in future periods, like in Peterson and Raj in '94. But then with banking integration, lending markets become more competitive, so banks have to break even every period, like in a Diamond 84 world. And so what this means is that we expect shocks with low temporal dynamics to matter more after integration. And that is, shocks with low AR1 persistence are likely to have a greater impact. Our third hypothesis is that negative shocks operate more like bank capital shocks because they are more likely to affect a bank's total amount of loanable funds by pushing banks closer to their capital constraints. So for this reason, they're unlikely to be transmitted across state boundaries in the standard mechanism that we propose. So this table corroborates our hypotheses. We find that the point estimate of the interaction term is negative and statistically significant across all specifications, which indicates that after integration, economic growth increases more in state I when shocks in state J have low temporal correlation, they're geographically isolated, and when they're positive. So essentially, when these shocks do appear to be more idiosyncratic in nature. Now, a lot of the questions that were raised relies on this assumption that banks didn't expand across state lines after banking integration. And our measure of state pairwise banking deregulation simulates the geographic expansion across state lines, but the actual expansion is an equilibrium outcome that may not have been affected by the removal of regulatory barriers. So to understand whether banks actually expanded across state lines, we use historical data of assets held by out-of-state banks from Berger, Kashyap, and Scalise 95 to look at this. So this figure presents a CDF of the gross domestic assets held by out-of-state bank holding companies. And you can see that the share of gross domestic assets held by out-of-state bank holding companies is highest for the banks that had deregulated earlier. And banks that deregulated later have a lower share exhibited by the cumulative probability. We also look at the within-state temporal variation in the share of gross domestic assets owned by out-of-state bank holding companies. And we find that the average share increases over time, which suggests that banks are indeed expanding into states after deregulation occurred. We also find that there are key differences between early deregulators and late deregulators. So when we aggregate the share of gross domestic assets held by out-of-state deregulators, held by early deregulators and compare it to late deregulators, we find that the average share is higher for the early deregulators. And a key finding here is that there are heterogeneous effects in the point estimates across different states. So states like Vermont, Washington, Indiana, DC have a super negative point estimate, while states like Alaska, Utah, Connecticut, and New Mexico are very positive. So putting these two things together, we try to explore what potential factors can drive these heterogeneous effects. Now, what we find is that the median deregulation year and the change in the amount of assets held by out-of-state banks are two possible determinants of the state level estimates. So the figure to the left shows that if you take the median deregulation year for each state, it is positively linked with the state pairwise coefficient. So states that deregulated much later have a more positive point estimate than those that deregulated earlier. And similarly, states that didn't experience that much of a change in gross domestic assets also have a larger coefficient. So if we believe that there's a state that only specializes in technology and other banks are unable to enter that state, this seems to suggest that that state is not going to experience negative transmission of idiosyncratic shocks. But this analysis we can only do at the aggregate level, given limitations of data. So these relationships we codify more rigorously through a robust regression specification, but that's in the paper. So I'll skip that in the interest of time. One key finding is that there's a reallocation of funds to bank-dependent borrowers. What we do is we regress the idiosyncratic shock in the home state on idiosyncratic shocks in the foreign state, and an indicator for whether the two states have integrated for small firms and large firms separately. And we find that the reallocation of funds primarily affects small firms. You can see the point estimate is significantly larger for small firms than large firms, and statistically significant at the 1% level. So this finding suggests that firms which are more dependent on banks as a source of external financing drive the aggregate response in economic growth across states. So to further understand the role that reallocation has in driving economic activity, we use age as a proxy. So
So is it something that is linear in size? I mean, when you say small and large, is it like below the median and above the median? And did you look at a more continuous measure of size?
So the way we define small and large is large firms are the top 10 firms in each state, and small firms are all other firms. And so it's not quite linear in the sense that we're cutting it off to 10 because 10 is what we use to construct the idiosyncratic shocks. In robustness, we did vary the number of firms that are used to construct the idiosyncratic shock and show that the results are robust even after we include a larger number of firms. Okay, so here we look at whether firms that are more dependent on banks as a source of external financing drive the aggregate response in economic growth. And so we use age as a proxy for dependence on external finance, and we show that younger firms are more responsive to foreign idiosyncratic shocks after banking integration. So specifically, we find that younger firms exhibit greater sensitivity of debt growth, sales growth, market to book ratio, and work in progress inventory growth to foreign idiosyncratic shocks relative to older firms after banking integration. So what are the implications of this work? The Great Moderation refers to a period of stable macroeconomic activity starting from the mid-1980s, but it's still deliberated what actually contributed to stable macroeconomic activity in this period. The three most common hypotheses explaining the Great Moderation are good luck, improvements in monetary policy, and broad-based structural change. So the good luck hypothesis posits that the Great Moderation resulted from pure luck, that shocks became smaller and more infrequent, and if the frequency of shocks is lower or the events are smaller, then aggregate volatility is lower. The improvements in monetary policy hypothesis suggests that improvements in monetary policy shifted the economy closer to the efficient frontier described by the Taylor curve, and specifically policies that focused on the reduction and stabilization of the inflation rate also decreased the volatility in real prices and interest rates, which in turn reduced volatility in investment and consumption decisions. And the third hypothesis is the structural change hypothesis, which argues that changes in economic structure reduced volatility. That includes labor market changes, increased adoption of information technology, computation, and communication. And the idea is that these changes made the firm more stable, which reduced fluctuations in inventory and reduced output volatility. So we don't dispute these prevailing hypotheses, but we propose an alternative mechanism which may explain the persistence of low volatility during the Great Moderation. And specifically, we argue that banking reforms, namely banking deregulation, which took effect in the 1980s and 1990s, increased the overall role of banks in intermediating shocks between states. So with banking integration, banks could cross state lines and operate, so their investment choice set expanded. And this allowed them to geographically diversify their portfolio. So in other words, before banking integration, when shocks in one state were correlated with growth in another, aggregate fluctuations could be quite large for the overall US economy. But then afterwards, the negative cross-state correlation may have allowed banks to ultimately hedge their portfolio and reduce risk, lowering the level of aggregate fluctuations.
So this is not clear to me at all. I mean, first of all, we know this is global. The Great Moderation was present in other countries, not just the US.
Yeah.
Right. So, but what you just described is not obvious to me at all, that aggregate volatility is going to decrease. Of course, I'm putting aside the financial crisis in 2008 and, the increase of size of banks and all this stuff. But even if I end the sample before the global financial crisis, you're telling me that now the states, the output is becoming more volatile potentially, because now your output is responding to the idiosyncratic shock in other states. But then what you're telling me is that because they're idiosyncratic, somehow the law of large number kicks in. Like, I need to see the math. It's not obvious to me your conclusion of, based on the results you showed us.
So the key idea is that we end our sample before the financial crisis, so we don't have that period included. But the idea is that aggregate volatility for the US economy can be thought of as the sum of individual variances for individual states, as well as the covariance across states, across all 50 states. So before banking deregulation, this covariance term is quite large because it's positive in nature. And the idea is that after banking deregulation happened, the covariance term is negative, but the individual variance terms are likely to be positive, as you suggested, and they're likely to increase in magnitude because the economies are more susceptible to idiosyncratic shocks. The argument is that if this covariance term, that the decrease in the covariance is larger than the individual increases in variance, then overall volatility may decline. And so we calibrated this to a model of Kalem-Leoshan, Papaiono, and Perry, and then do some exercises when we show that if there are exclusively productivity shocks and you have more banking integration, then theoretically it can lead to a reduction in aggregate volatility. But if you have both productivity and bank capital shocks, it can go in the opposite direction. So what matters is the correlation of shocks in addition to the degree of banking integration.
Okay, I'm not sure. So are you particularly invested in this motivation of the Great Moderation? I think it's a bit of a...
No, we're not invested in it, and it's more of a suggestion that in addition to considering the three hypotheses out there related to technological change, good luck, and monetary policy, this may be another dimension to consider. But this is not the main motivation of the paper, that we've solved the Great Moderation. Okay, so then we do standard robustness checks. I won't go into this, but I'll just discuss two of the major concerns. One concern is that the interpretation of our results relies crucially on the assumption that idiosyncratic shocks identify non-capital shocks. But it may be possible that the construction of idiosyncratic shocks doesn't purely capture non-capital shocks for a variety of reasons. One hypothesis is that large local economic shocks can affect both large and small firms, and shocks to large firms might spill over to small firms through supply chains or other networks connecting them. In both of these cases, our idiosyncratic shocks can capture shocks that contemporaneously affect bank capital. So what we do is we go through a number of exercises to study whether these concerns will threaten our core hypothesis. First, we show that contamination of non-capital shocks by capital shocks will bias our results and result in amplification rather than substitution. Second, we present a narrative analysis, which I showed earlier. Third, we also include state cross-year fixed effects in addition to industry cross-year fixed effects when we construct the idiosyncratic shock to capture, if you believe that there's some degree of state-specific macroeconomic cycles that can affect the shocks that are measured. And we show that even when we control for state cross-year fixed effects, the magnitude is larger than our baseline analysis, which strengthens the first argument that the estimate is likely to be understated if the shocks are contaminated by bank capital shocks. We also look at whether idiosyncratic shocks to large firms can predict idiosyncratic shocks to small firms, and we find that there's very limited evidence of that. And then we directly control for shocks to small firms in the domestic and foreign economies and find that our estimate remains robust. And then lastly, as an exercise, we directly control for bank capital shocks by including loan lease loss provisions in the foreign economy that experiences the idiosyncratic shocks. And again, we find qualitatively and quantitatively similar results to our baseline findings, which reinforces the idea that the shocks are not likely to be contaminated by other shocks that affect bank capital. The last concern that you may have is geography-based mismeasurement error. So a common concern is that we rely on data from CompuStat to identify state-level fluctuations. And oftentimes, headquarters don't align with where the majority of operations take place. So past work has found that headquarters and production facilities tend to be clustered, and headquarters represent an important fraction of real estate assets. It's also found that the majority of employees of a given firm also tend to work at the headquarters. Now, even if this is not true, the issue is not important to us as long as the spatial distribution of error between states I and J isn't systematically correlated with the timing of deregulation between two states. And we've also redone the analysis to circumvent this geography-based mismeasurement error by solely looking at value-added shocks at the industry level and using oil exploration shocks to corroborate our main findings. There are limitations of using oil exploration shocks, namely that the sample is too small, so there's low statistical power, and value-added shocks are more likely to operate as bank capital shocks. But overall, the additional analysis indicates that the results aren't driven by some anomalous features of CompuStat headquarter data. Okay. So to conclude, this paper identifies the effect of banking networks on the cross-border transmission of non-bank capital shocks. We introduce new empirical findings on how non-bank capital shocks transmit through the economy through banking linkages. And specifically, we show evidence that geographically diversified banks divert funds away from states that experience negative shocks towards unaffected state economies. And these results suggest that the transmission of non-bank capital shocks can result in the negative co-movement of business cycles. Thank you.